Okay guys, so welcome to today's video where I've just finished a live webinar for people who had asked me a lot of questions about risk management, volatility, how do the professional markets know where to place their stop losses, their take profit targets, how do I calculate how much to place on a trade, how do I trade the currency markets compared to the commodity markets, crypto markets. I've literally broken down a variety of really important subjects that you really need to understand to have an edge when you're trading. Now this is for you guys. I'm doing this to share with you my understanding about the markets, how the professionals use volatility, how they understand interest rates affect currencies, and how you can use these Excel spreadsheets that I have available for you to get your trading up to scratch and to make sure you're trading like a professional. So I'm going to take you over to computer screen. I'm going to share with you all this information. Please subscribe to my YouTube channel, share, like and comment, leave some feedback, and hopefully you also join my service as well and trade alongside me if that's what you're interested in doing. So I'll see you after the video. Take care. Thank you for watching. Okay guys, so 30 seconds we'll be starting the webinar. Hello everyone, hope you can see me. A good afternoon to everyone where you are in the world. So if it's the morning time, afternoon, evening, I hope you're having a good Friday. I hope you've had a good week. We're going to touch on some really important subjects today, which is I'm really excited to share with you guys because risk management, volatility, interest rate differentials, there's a lot of things that people are unaware of when they're trading, which is so important to understand. First of all, guys, I did have coronavirus, and there is like a long-lasting, lingering cough that does happen for a few weeks after your symptoms have gone. So I don't have the virus anymore, but I've got this really annoying cough. It feels like I've got a hair in my chest. So if you see me coughing, I apologize. But it is part of the after symptoms of the coronavirus. Okay, so guys, in today's webinar, there's a few things I really want to touch on that's so important for people to understand, okay? I can't stress this enough that when you are trading the markets and you are unaware of a few things that are, that are happening, you can really start to lose a lot of money, especially when it comes to risk management and people really not understanding about how to manage risk, which is a subject I'm going to touch on first before we go over to some other key subjects such as interest rate differentials, so on and so forth. So one thing we need to understand, guys, is when you're trading the financial markets, investors have to understand volatility of an asset to understand how much it fluctuates by. And that goes for if you are intraday trader and you try to make profits within a day, you need to know historically how much, for an example, the price of gold, like we're looking at this chart here, how much does gold fluctuate on a day-by-day basis for you to be able to put a stop loss at a certain price that gives you the room to allow the markets to fluctuate but not stop you out of a trade if you're intraday trading. If, for an example, you trade over weekly charts, weekly time frames, you need to know how much does gold fluctuate by on a weekly basis. And then if you're trading monthly time frames, you need to understand how much does gold, a currency pair, oil, how much does cryptocurrencies fluctuate by on a monthly basis for you to get into the trade, put a stop loss at a certain price to make sure that you don't get stopped out of the trade. But more importantly, then when we start to implement risk to reward, remember, for us to grow our accounts, we need to understand that we always have to be trying to aim to make at least 3 times as much on a winning trade than we would take from a loss in a losing trade. So let's say, for an example, I have a £10,000 account, right? And let's say we only want to risk 5% of our account on a single trade, right? So what you always do to work this out as a calculation, just so you know, it's really easy to do. You do 5 divided by 100 times 10,000. So let's say that's your account. You're risking 500 per trade, okay? That's your maximum loss that you could take if you only want to risk 5%. But it would make sense that if you want to be making, if you always want to be growing your account as you're trading, you always want to be aiming to make at least 3 times as much on a winning trade than you would on a losing trade. So if you're risking 500, then of course with 3 to 1 risk to reward, you want to be making 1,500. So you want to be making at least 3 times as much than a potential loss. So the point behind that is, if I win a trade, then now I have to lose 3 trades in a row just to lose my previous profits. But if I win 3 trades in a row, now I have to lose 9 trades just to lose my previous profits. Do you get what I'm saying? So whenever you're aiming to make 3 times as much on a winning position than you would lose if you lost the trade, then every time you win, now you have to lose 3 times in a row just to go back to where you started. So risk management in terms of using a risk to reward ratio to aim to make 3 times as much as your lose on a trade is really important. But ATR volatility is the most important thing. So we're going to touch on ATR volatility because it is very important. And I'm going to break this down for you in more detail. So I have a spreadsheet that I use on Excel. And what you're doing is I'm looking at the US dollar, for an example, against every single currency pair in the markets. Now I'm looking at the US dollar in terms of the volatility. So how much does the US dollar fluctuate by against, for an example, the British pound on a daily basis here? How much does this currency pair fluctuate by on a weekly basis? And how much does this currency pair fluctuate by on a monthly basis? So again, if you're an intraday trader, you need to know how much does this currency pair fluctuate by on a daily basis. Now, if you go back and we analyze over the past 2 years, the average daily volatility for, oh, sorry, this is the weekly. I just realized that I got that wrong. My apologies. So apologies, guys. I think I've got that wrong. Okay, no. So sorry, I've got it right. Apologies. I thought I made a mistake there. Okay, so we're looking at the pound USD. So what we need to figure out is, guys, if we're going to trade the pound against the US dollar, we need to know how much does the pound dollar fluctuate by on a weekly basis, monthly basis, and on a daily basis. So let's say we are looking for opportunities to trade the markets. We obviously want to be trading timeframes that give us the most volatility, because the most volatility is giving us the opportunity to make the most money. The more a currency pair fluctuates, the more money you can make. So obviously you want to pay attention to always trading bigger time frames, so monthly charts, right? That's why I trade 1 to 3 month ratios. I'm always looking to get in the position and try to hold a trade for at least 3 months, because that's where the most volatility is. So for an example, the pound fluctuates against the US dollar by around 4.53% per month. That's how much it fluctuates by. So if you are buying the currency pair and you're anticipating that the pound goes up in value against the US dollar, then historically it's going to fluctuate by around 4.5%. So this spreadsheet calculates all of the data for you on a monthly basis, on a weekly basis, on a daily basis. So you know if I'm getting into a position where I need to place my stop loss, because historically this spreadsheet is getting the data from investing.com, which is a website which is given to you in the links on the spreadsheet. So if you go to the top of the spreadsheet, you have links, and literally you go to investing.com. And once you go to the link in the spreadsheet, you can literally go to the spreadsheet, the website, sorry, download the data. So what you're doing is, for an example, there's different time frames on the spreadsheet. So if you're looking at daily data, we are looking at, for an example, the pound against the dollar over a period of time going back from October 2020. This was the last time I updated the spreadsheet, and it's going up from October 2020 till 2000, and when we're going back to 2000, and I think it's 2010. So I took 10 years of data, and then I'm analyzing this 10 years of data. So this is what's so important about using volatility analysis. Once you use this data for 10 years, guys, you know this is the data. This is literally telling you what the market has been doing for the past 10 years. So this data obviously is not going to be wrong, because it is the data. You're going to a website, it's telling you this is how much the currency pair has fluctuated by on a daily basis over the past 10 years. You take the same data on weekly charts over the past 10 years, and then we do the same on the monthly chart over the past 10 years. So all you do is you literally go here, for an example, and you can change the currency pair you're looking at. So let's say we're looking at the Great British Pound against the US dollar. We go onto investing.com and we have a look at the data on a daily chart, on a weekly chart, and a monthly chart. And then here you can just look at the dates and you can go back 10 years. And I'm going to explain to you now why this is so important, guys. So you can literally here go from today's date, as you can clearly see here, and you can go back 10 years if you wanted to 2011. And now you have all the data for the 10 years. And then you can literally press download. And then I'm going to show you at the end of the video how you update a spreadsheet. But the most important thing is, guys, why are people losing trades all the time in the markets and not understanding why? Why is it that you get into a position and the trade is actually a good idea? You've actually guessed the direction right. But then, for example, the trade hits your stop loss and you lose money on a position. This is the most frustrating thing that happens to every single trader in the markets. It will drive you insane. And the reason is not understanding volatility and not understanding how the markets fluctuate by. So the point I'm trying to make is if you're trading the pound against the US dollar and you have a position in the markets where you're thinking to yourself, I really want to be buying the pound against the dollar, you need to know how much does this currency pair fluctuate by on a monthly basis. Because if you don't, you may get into a trade and you may just in your head say, oh, let me put my stop loss at 200 pips. But you're not understanding that the spreadsheet is telling you that the pound dollar exchange rate fluctuates by on a monthly basis by 4.5%. That has historically happened for the past 10 years. So you need to know that if I'm trading on a monthly time frame, I need my stop loss to be around 4.53%. Because if you have it any smaller, you're likely to get stopped out of a trade, and then it's probably going to go in the direction of the position of the way you guessed it to go into, and you're going to lose money. And it's going to be the most frustrating thing you ever go through. This happened to me for years until I properly understood about volatility, and I learned this. And then literally sometimes you'll see fluctuations in the markets and you'll see pullbacks within a trend, and it literally will come just around the volatility analysis that you put in, and it will come close your stop loss and it'll go right in your direction. You'll literally start to learn how much just understanding volatility can save you from losing a trade. So we have weekly, monthly, and we have daily data in the spreadsheet. So you're looking at all of these. You look at the Aussie dollar, US dollar, for an example. We're looking at all these different currencies, the euro, for an example. There's so much data here for you to understand. So why this is really important is because, let me give you some examples if you don't understand pips. If you don't understand pips, then you're really going to get yourself in trouble. So let's say, for an example, let's look at the euro USD. I want to show you a really good example of this and how this will stick in your mind once you understand this. Let's look at euro USD and let's look at the USD Norwegian kroner, okay? So let's say, for an example, the euro USD fluctuates by, on average, let's have a look at euro USD. So on average, euro USD fluctuates by around 0.64% per day. That's a daily fluctuation, okay? So let's look at this on a chart. So euro USD, if I was to trade euro USD, and let's say I wanted to buy this exchange rate value at this moment in time, historically, 0.64%. So if I wanted to buy it, I know my stop loss would have to be 0.64%. Okay, so let's say it's around here. 76 pips would have to be my stop loss to make sure. And pips is basically an exchange rate value. It's really quite a lot of information for you to go into in this video. But if you are trading, I'm sure you understand what points are. If you're not, then it's something I do teach in my course. If you are looking to get into currency trading, it's really important to understand, because pips is the exchange rate price changing by a certain amount every single day. But the point I'm trying to make is, for the euro USD exchange rate on a daily basis fluctuates by around 0.63%, which is 76 points. Let's compare that to the USD Norwegian kroner. How much does the US dollar Norwegian kroner exchange rate fluctuate by to get to the same amount of 0.63? 537 points is how much it moves to get to the same value. So clearly, exchange rates move differently in terms of pips. And if you don't understand that and you're trying to get into a market or a currency pair and you're trying to trade it, and you don't understand that you can't compare exchange rate opportunities in terms of pips, but you have to do it in terms of percentages, you're going to stop yourself doing stupid things. Because let's say you look at trading USD Norwegian krone and you say, I want to buy this currency pair on a daily basis. I'm going to make some intraday money on this currency pair, and I'm going to put a stop loss at 100 pips. But you don't even understand that this currency pair fluctuates on a daily basis by nearly 500 pips on average or more. You're going to lose money. You're going to get caught out. You're going to get stuck in a trade where you don't even understand how much this currency pair fluctuates by on a daily basis, and you're going to lose. And it's not just looking at this currency pair. There's other exchange rates that move even more on a daily basis. So let's have a look at the USD Norwegian kroner, just to really ram home my point, because I really want you guys to understand it, because I don't want you guys to be losing money. I don't want you guys to be taking trades and making these mistakes. I don't want you guys not to have this data, look to get into the markets and make money, which you all deserve to do, and then you're going to lose. You're going to think you're not good at what you're doing, and it's got nothing to do with your ability. It's just got to do with your education. You just don't understand. Okay, so look, USD Norwegian kroner, it actually fluctuates by 1.32% per day historically. That is a fact going back 10 years. So if you want to intraday trade this currency pair, your stop loss would have to be around here. 1.32, sorry, not 22, 1.32, so around here. 1,142 points is how much your stop loss would have to be. And if you don't know how to calculate that in terms of how much you'll be putting on that position, you're really going to get stuck in trouble. And you could blow your account in one trade. You could lose all your money, or you could put the trade on the right direction and make loads of money, but you wouldn't have actually understood what went in your favor. So this is the point I'm trying to make. Volatility analysis allows you to compare opportunities in the markets. The currency pairs that fluctuate by the most in terms of percentage terms, that's the currency pairs you want to focus on, because that's where the opportunity are. If a currency pair doesn't fluctuate a lot on a daily basis, that basically means there's not that much of an opportunity to make money. Volatility as a trader is your best friend. The more something moves, the more you can make money. The more it's stagnant and stays flat, the more you can't make money. Okay. And to control your risk management and to make sure you don't lose money in your trading account and blow your account, you need to know, if I'm trading on a daily basis, where is my stop loss? So if, for an example, look at the point we spoke about earlier, if the stop loss here is 0.63%, then at least my take profit's going to have to be at least 1.83%, 3 times as much bigger than my stop loss. Because again, as we spoke about, if you want to grow your account, you need to win one winning trade with a 3-to-1 risk to reward, because the moment you win one winning trade, it takes 3 trades in a row, losing trades in a row just to break even. So you're always protecting your capital. You're always growing your account. But this is where intraday trading gets really tricky, because if Euro USD fluctuates by 0.63% on a daily basis, that is historically the data. You can't argue with the numbers. If that's what this spreadsheet's telling you, that's the volatility per day, then how on earth can you put your stop loss at that much to make sure you don't get stopped out on an intraday basis? You know you have to use an intelligent risk to reward to help grow your account. So you have to take profit at least 1.83%. But if the exchange rate only fluctuates by 0.63% per day, how are you going to make 1.83% in a day? You can't. And that's why intraday trading is so difficult. And that's why intraday traders lose so much money. And that's why investment banks, hedge funds, they're not in and out of the market every day. They're portfolio managers. They're catching fundamental trends over big time periods. So monthly charts, for an example. This is why volatility is so important, because then you start to realize a lot of the education you're getting taught by people online is fucking bullshit. If this currency pair fluctuates by 0.63% every single day, that is the historical data you cannot argue with, and you want to use an intelligent risk to reward to grow your account, you cannot trade this currency pair on a daily basis, because it doesn't move 1.83% per day. It doesn't do it historically. You've looked at the data for yourself. Maybe over a weekly time frame for Euro USD, you may get close to that, but that means you'd have to hold that trade for a weekly time frame. So yeah, 1.61% over a week is actually how much this currency pair fluctuates by. So you'd have to hold that trade for a week to get that return. Okay. So obviously the point I'm trying to make is, guys, let's start looking at monthly volatility. That is the best time frame to give us the most amount of profit because it moves the most and we can allow the markets to fluctuate and to get into a trade. So let's go back to our example. Let's say we're looking at the pound against the US dollar. So we know that if I want to trade the British pound USD, I already had this example set up for you guys to really illustrate my point. Okay, let's say for an example, we're looking at the pound against the US dollar. We're saying to ourselves, all right, so at this moment in time, clearly the pound is rising against the dollar. The pound is on a bullish trend, right? The dollar is really weak across the markets. And I really should talk about this at the end of the video and break this down for you in more detail so you understand. But at this moment in time, the pound is strong against the dollar. So let's say we say to ourselves, okay, 140 is a good price. Let's say the resistance level is at 140. And we say if we break above 140, I am happy to commit capital. Okay, let's say the fundamentals behind this is because the US central bank slashing interest rates is making the US dollar very unattractive to hold in the currency markets, which I'll break down later in this video. This webinar, and I'll really explain this to you. Let's say we want to get in the market at 140. So we look at the pound USD exchange rate. Sorry, give me a second, guys. Just realized that my computer wasn't plugged in. I don't want the battery to die. Let's say we're looking at the pound USD exchange rate, and we're seeing that it fluctuates by 4.3% per month. Okay, so we know straight away 4.3%. If we're getting at 140, our stop loss has to be 1.353%. Remember, you have to use the ATR volatility. If you don't, guys, you're gonna get stopped out. You're gonna get really disappointed in yourself. You're gonna get upset. You're gonna think you're not good at trading. There's nothing to do with that. Your idea could be really good, but you just don't understand about the volatility. So our stop loss would have to be around 1.33, and our take profit with a 3-to-1 risk to reward would have to be up here at around 1.59. So how could we take this information and really work this out quickly in the markets so we don't have to do it manually? And this is what I have here. I have a spreadsheet, a risk management spreadsheet that I've created that all my members use, and it really helps them literally calculate a trade really quickly in the market. So this is a spreadsheet that I've created. It's automated and set up automatically for you when you're looking to take a trade in the markets. I'm going to break it down for you so you understand. So we're looking at the pound USD. You can change that symbol at the top to any currency pair you want if you're trading the currency markets. Let's say the price of the pound USD, we want to get in the market at 140. That's the price we was looking at, 140. So you put here, the market price is 140. That's the price you want to get into the trade, okay? And if you understand units and lots, the exchange rate value of 140 is equivalent to 14,000 units of the base currency. But that's basically how the exchange rate value is calculated. So the 1 month ATR we worked out from our spreadsheet, 4.53%. So all you're doing is you're putting in the price of the exchange rate you want to get in, 1.40. Sorry, wait for this to load. The price you want to get in at 1.40, the units automatically update. You don't need to ever look at the units. The stop loss volatility we just looked at, 4.53%. You put 4.53% in here, and then automatically it calculates the stop loss in pips. So let's say we did 1.44. You can see the calculation changes, okay? It all changes automatically. So what you do is you put in the price you're getting into the markets. You put your 1 month ATR volatility at 4.53%, and now it's telling you your stop loss needs to be 634 points, okay? That's really important. So now you know where you have to place your stop loss. Now, we know our 1 month ATR volatility is 4.3%, so our risk to reward with a 3-to-1 ratio, so 3 times greater take profit price, we know we have to have a take profit percentage of 13.59%. That's 3 times the size of 4.35%. So automatically we know that's our stop loss, that's our 3-to-1 risk to reward target. And then here we have the calculation for you to tell you where your stop loss is and your take profit target is. So this spreadsheet, literally all you do is you come into the top, you put 1.40, the unit is automatically done. You put your 1 month ATR volatility, which you had already from the spreadsheet. You just take it here, you get the information, you plug it into the spreadsheet. Automatically it's telling you need a stop loss of 634 points. And then automatically it's then you then put your stop loss in percentage terms here, and it's going to tell you where your take profit price is. And now you know where to put your stop loss and where to put your take profit target. And then when you go into the chart, it will literally be exactly the same value. So 1.59026, 1.59026, 1.33658. And then you have the same answer right at the bottom here for your stop loss. So here you have it, guys. This spreadsheet will literally tell you automatically exactly where your stop loss price needs to be and your take profit targets. Now, obviously, that's good, but to really understand risk management, we need to know how much to put on the trade to make sure we only lose a certain amount per trade to help our account still grow. So let's say you have an account balance of £10,000. In our example we spoke about, let's say we only want to risk 5% per trade. So at least if we're risking 5% per trade, then it gives us at least 20 trades before we lose our money in the market. So of course, if you lose 20 trades in a row, then there's something really clearly wrong with your trading style, and maybe you need to reevaluate your strategy in the markets. But let's say we're going to go for 5% risk per trade. So you put your account balance here, you put how much you want to risk per trade, so 5%, and then all this calculation here is 5 divided by 100, okay? And then this is telling you that you only need to risk 500 of your account. And what this is calculating here is the 5% divided by your account balance, and it's telling you your maximum risk is 500. So if you know you only need to lose £500, and that's 5% of your account, obviously how much are you putting on the trade per point to be able to make sure you only lose 500? And then you get the pip value here in this calculation. And this is basically telling you 500 divided by the amount of pips, and your account value, sorry, your pip value is 0.79 cents or pence per trade. So if you do the calculation on your phone, 0.79 divided by, sorry, 0.79 times 500, you get the answer for your stop loss and how much you will be losing on a trade. So do it on your phone, guys. 0.79 times 634, and you get the answer for 500. So these two spreadsheets you can use hand in hand. You can use the ATR volatility spreadsheet. You know how much you have to the market fluctuates by. You know how much you have to put your stop loss in, because it's telling you this on the spreadsheet. You have the daily data, weekly data, monthly data. So if you ever are thinking of intraday trading, then you can literally go onto this spreadsheet, look at the daily volatility, then figure out yourself, well, if it fluctuates by this much on a daily basis, I know that's when my stop loss has to be. If I want to make a smart risk to reward, then maybe I can't be day trading. So maybe I should look on the weekly timeframes, or maybe I should take a look on the monthly timeframes. And then you can come over here and you can use this spreadsheet to literally just put in the price of any exchange rate, and it will calculate the value for you automatically. And I'll do this right for you now in a different example. Let's just take any currency pair in the market. So let's take the Aussie dollar, US dollar for an example. So it fluctuates on a monthly basis by 5.09%. Okay, so let's look at the Aussie dollar, US dollar right now in the markets, and I'll give you a live example. Okay, so let's say you want to buy the Aussie dollar, US dollar. The exchange rate at this moment in time is 0.76085. So let's go over to the spreadsheet and let's do this right now as a live example. Apologies for my computer. I don't know why it's moving so slow today. It keeps freezing. Maybe it's because I'm doing a live Zoom. So the exchange rate price is 0.76091. That's exchange rate value. The 1 month volatility stop loss that we looked at for this is 5.9%. Okay, so hold on. 5.09%. So it's telling us our stop loss has to be 387 points. So in the stop loss here, I put 5.09. Now it's telling me where my take profit target has to be and my stop loss has to be. So let's calculate this now and let's see if this is right, just to give you a live example of this. So our 1 month stop loss is 5.09%. Let's take this and let's go down 5.09%. 5.09%. So around here. So saying 386 points, and our stop loss is telling us 387 points. So there you go. It's literally telling you where your stop loss has to be. Okay. And it's saying the price of the stop loss should be 0.72218. And we got a stop loss of 0.72251. So literally bang on the money. It's telling you where the stop loss has to be. And then for our take profit price, it's telling us that our take profit price should be, where is it? 0.87710. So sorry, how much is it in terms of, okay, 15.27%. If we're doing risk to reward of 3 to 1, 15.27%, right? Okay, so 1,160 points. And it's telling us the price should be 0.87710, 0.87759. So there you have it, guys. That's exactly what the spreadsheet will do for you. You literally punch in the numbers really quickly, and it's going to tell you automatically where to put your stop loss, where to put your take profit. And then again, let's say you have, I don't know how big your account is. Let's say your account is 2,000 for an example, and you're risking 5%. Now you know that you're going to be doing 0.26%, 26 pence per point to put on this position, and make sure you only risk the 5% you want to risk. If you want to risk more, you can risk more. Let's say you want to risk 10%. Now you're going to know you're going to put on so half a pence, so 52 pence per point you're going to put on the trade. That's literally this spreadsheet helping you do this. So ATR volatility and risk management are the two important factors, because if you don't get it, guys, remember, you're going to put trades on in a currency pair. Like we looked at the US dollar, Norwegian krona. You may not know it fluctuates by 1,000 points in a day. You may try to trade it and you don't even know where the stop losses should be. You don't know how much this currency pair fluctuates by on a day-by-day basis. You don't know where to put your stop loss. You don't know where to put your take profit price. You may not even understand why the currency pair is trading in the direction it is. There's going to be problems for you in the markets. So this ATR, you got all the US dollar currency pairs, and it's not just the US dollar currency pairs. I have volatility ATR for the metals. So if we're looking at gold price in euros, if you want to trade gold in euros, if you want to trade gold price in US dollars, gold price in British pounds, you have the volatility for all of the metals, for an example. So obviously gold is a heavily traded commodity. So there you go. In the spreadsheet, you have all of the metals ATR volatility analysis. You have the US dollar ATR volatility analysis. You have crypto ATR volatility analysis. And this is really important to understand, because if you're looking at crypto at the moment, guys, crypto's booming right now. You're seeing Bitcoin rallying dramatically in the markets. And you know what? I'm going to touch on this right now, actually, in this video, because I think it's so important for you guys to understand. Bitcoin shot up 900% since March of last year. That's how high Bitcoin went to its peak. And we're now basically back at the peak at this moment in time. Why did Bitcoin go this high? And it's all because of Sorry, let me just take this away for you guys for a second. So you got Bitcoin's ATR volatility here. So you can look at how much Bitcoin fluctuates by on a monthly basis. For example, here we go. We got Bitcoin on a monthly basis fluctuating 30%. On a weekly basis, it's fluctuating 13%. On a daily basis, it's fluctuating 5%. So if you do try to intraday trade Bitcoin, you need to know where the stop loss should be, 5%. You're going to do a weekly trade, you need to know the stop loss has to be around 13%. You're doing a monthly trade, you need to know the stop loss is around 31%. Then what you need to understand is, why is Bitcoin going so high? So let me give you a prime example of this trade. Sorry, let me just close some of these tabs, guys. I think Zoom really does slow down your computer. Every time I do a Zoom call, my computer just starts to move really slow. So let me just try to close. No, we need this spreadsheet. This is a really important one I'm going to show you next. And guys, also we've got stock market ATR volatility. You're trading the US S&P 500. You want to trade the UK stock market, any stock market in the world. I've done all of the stock markets here for you guys. So you have all this data here in this stock market spreadsheet. So the daily, monthly, and weekly data. And then we've got crude oil. So we've got the oil price. So you want to trade oil. I'm trading oil right now. My members are in the trade. We're in a really good profit at this moment in time for oil. We bought oil a few days ago. And again, the stop loss I'm using is based on the volatility analysis. So let's have a look at Bitcoin, because if you're trading Bitcoin, you need to know what's going on. You need to know why markets are buying Bitcoin. There's a fundamental reason behind it. And I'll talk about the market's understanding for Bitcoin. And I think I should talk about gold as well, because it's the same reason gold goes higher as well. So gold and Bitcoin have been moving higher for the same fundamental reason, which you need to understand. All economics, guys. Every time the market moves, there's a fundamental reason behind it. So if you're trying to trade technical analysis alone and you don't know why investors are doing what they're doing, good luck. You're going to get caught on the wrong side of the market, because, guys, it takes patience, man. You got to understand, you got to study, you got to know what's going on. Just looking at charts and trying to find chart patterns is not going to make you money. The charts move, yeah, of course they move, but they move for a fundamental reason. And I'm going to explain this to you right now. Inflation is the one thing that makes investors get scared, because inflation erodes the purchasing power of your paper money. If inflation is rising at 2% per year, that means the value of your money is going down by 2% every single year, if that's the way inflation is, okay? So what investors do is they buy government debt as a way to hedge the risk of inflation eroding their purchasing power of their currency. So you borrow money to a government, because the government doesn't get enough revenue from their taxes to cover the cost of running their country. So the government says to the private sector, borrow me money, I'll pay you back your money plus interest. What's the risk of the government defaulting on the debt? Very slim, especially when central banks can print their own currency, because they can print more money to pay off their debt. So it's really a situation where you're not really going to lose your money. So investors buy government bonds, okay? And the bond should pay more interest than inflation. So if inflation is at 2%, the bond's interest rate is at 6%. You don't care about inflation because you're making 4% interest on over inflation. So your money's increasing by 4% per year. So however much you're investing in that bond, it's going to go up in value by 4%. And inflation hasn't been able to erode the purchasing power of that amount of money you put into a government bond, right? So we have the interest rate on government bonds since 1990 to the current day. We have inflation, which is the target for the central bank, at 2%. So what we do is take the interest rate minus 2% inflation, and that's how much interest you're going to be getting paid on the bond over inflation. So 6% interest over inflation, happy days. My money's keeping its value. It's actually going up in value by 6%. I'll buy bonds all day. But what happens when the central bank slashes interest rates to zero, where they are right now because of the coronavirus pandemic, but inflation's at 2%? Now your money's not making any money when you buy a government bond. Your money's actually losing money. Right now, when you take away 2% inflation from the government's interest rate in the United States, every dollar you hold is losing 1.25% of its value. So what do investors do? Look, on the left-hand side, you have interest rates adjusted for inflation. So interest rates minus the 2% inflation rate. Look what happens when investors who were getting 2.2% interest over inflation, when that interest rate starts to drop because central banks are slashing interest rates, investors start to realize, I can't be holding government bonds. I have to buy something else to hedge that risk against inflation. What do? Look at gold. They buy gold. Gold shoots up in value because now you don't want to be buying government bonds. What else do you buy? You have to buy something to protect your wealth. Investors buy gold. This is the fundamental reason why Bitcoin from March shot up so high in value when the central bank started to cut interest rates in the United States last year, March times. I'm going to show you exactly when the interest rate got slashed. Look at Bitcoin last year from March. Hold on, let's get this over here. This is gold. This is gold against the US dollar. Sorry, gold price in dollars. March of last year, gold shot up immediately as soon as the central bank cut interest rates. Because remember, guys, government debt is the most securest investment you can have in the world, because the risk of a government defaulting on a debt is very slim. So when investors can't buy a safe asset like a government bond to protect themselves against inflation, they have to do something, go somewhere. They buy gold. From March, gold went up 42%. And as we know, Bitcoin did something incredible. Bitcoin went up 900% since when? March. Let me show you this. Fed. Here we go. Let me show you this, guys. And look, guys, you can see it here. When interest rates are dropping, the price of gold is going higher. As soon as the interest rates start to rise above inflation, gold drops in value. Literally, they move in opposite correlation, because when bonds are available to buy over inflation, investors buy it all day. When bonds don't pay interest ahead of inflation, they sell bonds and they go into gold, they go into cryptos, they go into stocks, they go into buying commodities that can hedge that inflation risk. And look, as soon as interest rates started to really dramatically drop since 2018, look at gold. Gold shot up in value in the markets. And this is exactly what's happening right now. So again, look, you literally saw it in the chart, guys. I've shown you the government's 10-year bond minus inflation from 2018. Look, it started to dramatically drop because the Fed started to cut interest rates. And look what happened since 2018 with gold. Gold from 2018 started to shoot up in value because investors had to buy the commodity to hedge the risk against inflation. And that's why right now, with the US government now set to pump in $1.9 trillion into the US economy, that's why Goldman Sachs, all the big investment banks, are forecasting gold to rally back up to around $2,300 an ounce. So they're predicting a 27% rise in gold. That's why gold's rising. And if I show you Bitcoin, it's exactly the same thing, guys. Look, again, interest rates started to come down dramatically. Bitcoin started to rally higher in the markets. Soon as investors can no longer protect the wealth of their assets from buying government bonds, they're buying gold, they're buying cryptos, they're buying stocks. That's the fundamental reason behind it. So here on investing.com, you can see this for yourself. Point I'm trying to make, guys, you really want these spreadsheets. These spreadsheets educate you. And what you can be doing is every month, every week, you go get the data, you put it into the spreadsheet, you watch the charts, and you literally see in real time what's happening, and you understand. So now you can trade intelligently, you can invest like a professional, you can actually understand why things are happening the way they're happening. And then go ahead, use your technical analysis strategies, get in the markets, make your money. That's what we want to do. We've only got one life. You want to live a good life, right? So understand what's going on. Share this knowledge with your friends, your family, your kids, and go and live a good life and understand how the professionals are doing it, because this is what these guys are doing. This is what hedge funds are doing. This is what investment banks are doing. This is what billionaires are doing. So why can't you do it? We can all do it. You just got to understand. It's just knowledge. It's just education. That's all it is. Go and implement it, guys. 1.75%. Interest rate got cut in March. Look, to 0.25%. No surprise. That's when gold shot up from March last year. Again, that's why gold shot up. That's why Bitcoin, shot up last year. So you want to be buying Bitcoin, you want to be buying gold long term. These are why all the investment banks are forecasting these commodities to continuously push to the upside. So what I would say about Bitcoin is wait for a strong break above the previous high, get in, trade it, buy it, and we can make some money, really good money on the upside. Let's say Bitcoin goes up again by another 900%. You're making a lot of money on that trade, you know? And this is something my members are in right now. We're in a Bitcoin trade and we're all making money right now. So It's good to understand what's going on. Okay, so that's Bitcoin, that's gold. Interest rates. Guys, I want to show you something, and I really hope you pay attention to this, because if you don't, and you don't understand this, and you are trying to trade currencies, you're really gonna self-sabotage yourself. Guys, please understand, interest rates. Interest rates literally drive the value of a currency in the markets. If you don't understand that and you try to trade a currency pair and you don't understand interest rates, you're really going to get yourself unstuck. Why is this? The interest rate set by a central bank in a country sets the cost of borrowing a currency, or it sets the price that you get paid when you put money into a bank. So the interest you get paid, you get charged interest rate, you get charged interest to borrow, you get paid interest to invest using that currency. Now that interest rate applies in the Forex markets. If I'm trading the dollar against the Mexican peso, if I want to be buying the Mexican peso against the US dollar, obviously I have to first own Mexican pesos, sell my pesos in exchange to buy US dollars. I have to pay interest, the lending rate in a country, on the Mexican pesos I'm borrowing, and then I receive interest on the US dollars that I'm purchasing. So you have the lending rate in Mexico, you have the deposit rate in the United States. So the interest rate is the cost of a currency. So you have the United States, wait, let's get the Mexico one up. Here, you have the United States, you have Mexico. The interest rate right now in the US, the interbank rate is 0.09%. The interbank rate for Mexico is 4.49%. That's the interest rate. So if I want to buy the US dollar against the Mexican peso, I have to pay the lending rate on the Mexican pesos of 4.49%, and I receive interest on the dollars I'm buying, and I receive interest of 0.09%. So automatically, guys, you and I both know Mexico has a higher lending rate than the United States deposit rate. So I'm losing money automatically if I try to buy the dollar against the Mexican peso, because the interest rate differential is negative in favor of the in terms of going against the United States. Mexico has a much higher interest rate than the United States. So buying the US dollar against the Mexican peso doesn't pay me. I lose money. Remember, this interest rate is over 365 days. So if I buy the US dollar against Mexican peso, I'm borrowing the pesos, exchanging them to buy dollars. I'm paying out 4.49% interest on the Mexican pesos, but I'm getting paid 0.09% on the dollars I'm purchasing. I'm losing automatically 4% per year on this trade. That's how much I'm getting. I'm losing. If I'm trading one lot of this currency pair, I'm losing $12 a day. On the flip side, if I buy the Mexican peso, on the other hand, I'm making money. I'm making $12 a day. I'm getting paid 4% interest per year. So why do you think around March time, when the Federal Reserve started to cut interest rates, the currency pair really started to sell off, and the Mexican peso has made a lot of strength against the US dollar. The dollar did make strength at the beginning of the markets, because when the stock markets crash all around the world, the US dollar is the world's reserve currency. So whenever there's uncertainty, everyone wants to own US dollars. So markets sold off Mexican pesos, sold off South African rands. All the currencies around the world lost a lot of its value against the US dollar during that first period when the coronavirus pandemic gripped the global economy. But then as soon as the Fed slashed interest rates to zero, basically, that's when the market said, hold on, I don't want to be owning dollars because I'm losing money as soon as I'm owning dollars. And that's why straight away the US dollar weakened against the Mexican peso. Go look at the dollar against every single exchange rate. The pound, the euro, the Canadian dollar, the Aussie, the New Zealand dollar, the Swiss franc, the Japanese yen, the Norwegian krone, the Russian ruble, every currency pair you can think of, the dollar got weak immediately. This is why. Because if you don't understand which way you're making money or losing money when you trade an exchange rate, you're not going to know where the smart money's putting their cash. They're never, ever going to buy the dollar against a currency like the Mexican peso unless there's a fundamental reason behind it. And the fundamental reason behind it could be that maybe there's a problem in Mexico, or maybe there's going to be extremely high inflation in Mexico, and maybe the central bank's interest rate does not protect the Mexican peso against inflation. So markets don't want to own the peso, so they sell the peso and they buy US dollars because maybe the interest rate is no longer protecting the value of the Mexican peso against inflation. If that's the case, yeah, we buy dollars all day. But if the central bank's interest rate in Mexico is above inflation, so it's holding the purchasing power of Mexican pesos, and then the Mexican peso has a much higher interest rate than the United States, why on earth are we not going to be selling this currency pair? You lose money the moment you buy this currency pair. You're losing money. Every night you're getting charged money by your broker. You're losing, you're paying out money. So obviously the only reason you would ever buy this exchange rate is if you thought that the exchange rate was going to go up in value during this first period when the stock markets were crashing and everyone wanted to own dollars. Yeah, the dollar went up 34%. That's a good trade. But the moment the interest rates got cut, market said, I don't want to be owning this currency pair. I want to sell this currency pair. And when the money fluctuated and went back in the opposite direction, we have a big trend to the downside. And this is why all of the analysts go on Bloomberg, listen on Bloomberg TV. They're all saying sell the dollar against emerging market currencies. Why? Because the emerging market currencies have the highest interest rates. So with the spreadsheet, what you want to do is anytime you take a trade in the currency markets, you want to go. I'm going to put the links into the spreadsheet for every single central bank's interbank rate link. So what you do is, I'm going to do it for you right now, just to show you how you do it. What you want to do is, you want to go to trading economics, guys. You want to go to the country you're trying to analyze. Let's say the United States. You want to go to money, interbank rate. It's telling you right here, the latest interbank rate 0.02. That's very low in the United States. So there you go. That's how you can find out the interbank rate. You can press it here and you'll get the interbank rate in the United States. So 0.020. There you go. That's the interbank rate in the US at this moment in time. If you want to pay for the data, which I would really recommend you do, you can go to the data links. You can go across the countries, go to United States, go to money, interbank rate 0.02. But you don't have to pay for it. Literally, as I just shown you how to get the data up for yourself. And then you come into the spreadsheet and then you put that in there for the United States, for an example, 0.2. So that's the latest reading. So reason I'm saying this, you guys, is because before you put on a trade, go and do this. Go and put into your spreadsheet how much the interest rate for the United States is, then put in the interest rate for the other country, and then put in how much you're going to be trading in terms of your lot size when you're taking a trade. And then you're literally going to know, am I making money or am I losing money? It's going to tell you right here. It's going to tell you how much per day you're making or you're losing. Okay, so selling the currency pair, buying the currency pair. You're going to know, am I going to make money every day? Am I going to lose money every day? And obviously, the moment you realize you're losing money every day, then you have to start asking yourself, why am I going to be buying this currency pair? If I'm losing money every day, I doubt any investors around the world will be wanting to lose money every day. Why would they want to do that? So really important, guys. If you don't understand this, then you're not going to know why the markets are trending where they're trending. Or let's say there is a situation where the dollar goes higher against Mexican peso, and let's say interest rates then start to get slashed in the US, and you don't understand this, it's going to be a problem for you guys because markets are not going to be owning that currency anymore. So, point I'm trying to make, guys, all of these spreadsheets that I'm speaking about, I don't need you to have it. You need you to have it because you need to understand what's going on in the market. So I have all these spreadsheets available for you guys. If you want them, it's on my website, kainsmarkets.com/university. You can go here. I have an additional video again going over all of this information for you, and you can grab yourself all of the spreadsheets, ATR volatility, interest rate differentials, everything's all there for you guys. Remember, I have a live service as well on my new free Telegram channel. So again, I'll be pumping more information on this channel every day, giving you some trade ideas, telling you what's going on in the markets. So if you are interested in trading and you want to get an idea of what's going on, then come along and you can get some free analysis in the markets for yourself. God, Zoom really does make your computer go slow. Jesus Christ. So here we have interest rates. You can watch the video. Risk management, that we was touching on for that spreadsheets. We have COT reports. This is really important for you to understand. Couldn't really cover that today. Look at this video of oil, for an example. Gold, as we was touching on as well. So it's all there for you guys. We have the service running up here. So what we're seeing is, guys, members channel. We have this free trading channel here. Again, I'll be putting video content in there for you guys so you know what's going on. The Aussie dollar, for an example, the South African rand, for an example, stock markets, what's happening with the European stock market. So much information, guys. You can come on, you can join, or you can join my trading team and follow my trades, follow my personal analysis. I have a support team that answers any of your questions throughout the trading day as well, if you want to trade alongside me. And it's all there for you. So if you guys have any questions, guys, yes. If you want to know where you get the ATR volatility data, guys, just go into Kinds Markets, watch the video. It will explain to you how you get the data. You can buy the spreadsheet for yourself. And you have all the spreadsheets there for you guys. Currencies, commodities, cryptos. And if you want anything else, you want me to do it for you, just contact me and I'll do it for you for free. If you've purchased it already, why not? I mean, I'm always here to help you guys. Also, remember, guys, if you're really interested in doing currency trading, I have a multi-course video package on my website where I'm breaking down how to trade currencies, how to trade commodities, how to trade stock markets, and you get 12 months free mentoring from me, and you get 12 months free membership, more importantly, to my service as well. So you're not hung out to dry and left by yourself to try to figure out everything that I'm teaching. So, guys, I hope you've really enjoyed this. It's been a pleasure. Come join my training channel for some updates. Peace and love. I'm going to upload this to my YouTube channel as well. So if you haven't watched this already, not a problem. You will get a copy of this to watch for yourself. So thank you for coming over. Got any questions, DM me or send me a message on Telegram. Speak to you soon.